In late January 2026, gold reached an all-time high of approximately $5,595 an ounce. The momentum suggested a continuous, unbroken rally. Weeks later, Operation Epic Fury commenced. A severe geopolitical conflict in the Middle East disrupted global supply chains and dominated international headlines. This chart tracks the spot price of gold in the months that followed. Instead of rallying on the news, gold plunged 25%, falling below its 200-day moving average and bottoming near $4,200 by June. This price action contradicts the standard financial assumption that geopolitical war automatically inflates safe haven assets. A major global conflict triggered a confirmed bear market in the world's oldest monetary hedge. Searching for an explanation, retail financial media filled the void with fabricated leverage ratios, rumors of market manipulation, and misidentified legislation to explain the sudden drop. To understand the actual price mechanics, we have to audit the tape. That means stripping away internet noise and examining the empirical macro, sovereign, and corporate data governing the asset. Navigating a $4,200 asset requires institutional-grade data, not emotional retail narratives. The most pervasive assumption among retail investors is that armed conflict guarantees a gold rally. The reality of 2026 requires looking at exactly what kind of conflict this was. The Iran and Strait of Hormuz disruption acted specifically as an energy shock. It created a severe bottleneck that drove crude oil well above $100 a barrel. That oil spike immediately altered the inflation data. Headline CPI accelerated to 4.2%, and producer prices hit 6.5%, even as core inflation remained contained. The market was suddenly pricing in an energy-led inflation shock. Facing an accelerating headline CPI, the Federal Reserve, under new chair Kevin Warsh, shifted its posture. The market rapidly priced out rate cuts and began preparing for a higher-for-longer monetary regime. This graph plots the 10-year TIPS real yield. In spring 2026, it crossed the decisive 2.17% mark, pushing risk-free real rates above the critical 2% threshold. Gold yields nothing, therefore the opportunity cost of holding a zero-yield asset rises sharply. Institutions reacted strictly to the math. Commodity trading advisors deleveraged their long positions, triggering $14 billion in record outflows from North American gold ETFs in March alone. The bond market's discount rate overpowered geopolitical fear. An inflation-driven conflict raises real yields, which forces institutions to sell non-yielding assets to raise liquidity. While yields drove institutional selling, retail communities blamed a viral rumor about something called the Clarity Act, framing it as a covert operation to destroy gold demand. The actual legislation governing this shift is the Genius Act, enacted in July 2025. This law created a federal framework for payment stablecoins. It requires all digital stablecoins be backed one-to-one by US dollars and short-dated treasury bills. The macroeconomic objective is direct. By forcing stablecoin issuers to hold reserves in government debt, the law transforms private technology firms into structural, automated treasury buying machines, absorbing the US deficit. Instead of relying on traditional commercial banks to buy debt, major tech corporations issuing digital coins now bypass traditional deposits to fund the government directly. The Genius Act engineers a digital Petro-Dollar. It weaponizes blockchain rails to expand US debt demand, creating a formidable defense for dollar dominance that competes directly against sovereign gold accumulation. On the other side of that competition is the physical market. A popular claim asserts the COMEX is operating on a 9-to-1 leverage ratio, $635 billion in paper claims against $70 billion in physical vaults. Those specific figures trace to no verifiable institutional dataset. Institutions are indeed walking away from paper gold, but the catalyst is regulatory, not a conspiracy. It stems from the Bank for International Settlements and the Basel III framework. The Basel III framework assigns an 85% required stable funding factor to unallocated paper gold. This rule heavily penalizes commercial banks for holding unallocated gold on their balance sheets, actively pushing the financial system away from the paper shell game. Official IMF filings show only 16 tons of net Q1 gold purchases, yet the World Gold Council estimate is 244 tons. Actual physical accumulation is roughly 15 times larger. Central banks utilize over-the-counter channels to build physical reserves entirely off the radar. This strategy accelerated after 2022. Freezing $300 billion of Russian exchange reserves proved that traditional fiat holdings carry severe political seizure risk. Physical gold held inside domestic borders cannot be frozen. Private institutions are following suit, though retail rumors often double the scale. A Chinese insurance directive allowing institutions to buy gold is real, but the capital cap is roughly 179 to 200 billion yuan, not the 380 billion frequently cited online. While Western retail investors fixate on unverified paper metrics, Eastern central banks and institutions are quietly executing a durable, multi-year strategy to accumulate physical ounces. For retail investors seeking to participate in a gold rally, the standard playbook involves buying senior mining equities to capture leveraged upside. The cash generation from these companies is immense. In early 2026, Newmont reported a record $3.1 billion in free cash flow. Yet generalist capital continues to discount the sector. Despite these margins, senior gold miners trade at steep discounts, hovering near 0.75 times net asset value. This equation dictates operational leverage. Margin change equals spot price change, divided by spot price minus production cost. Mapping Newmont's $4,200 spot and $1,680 sustaining cost, a 10% price increase yields a 16.7% margin expansion. However, theoretical leverage on a spreadsheet rarely matches the brutal historical reality of running a mining operation over an extended timeline. This chart compares 20 years of performance. Since 2006, the GDX Miners Index has drastically underperformed the physical gold ETF, GLD. Physical gold grew 492%, while the mining index lagged severely at just 153%. Mining businesses face severe headwinds. Rising gold prices inflate costs. Miners fight constant reserve depletion, and management often executes poor capital allocation at cycle peaks. Mining equities are not a substitute for gold bullion. They are cyclical wagers on management execution, subject to totally different risks than the metal itself. With the noise audited out and the institutional data clarified, we can map exactly how to deploy capital based strictly on the verified mechanics of the market. This matrix breaks down the three primary implementation vehicles, mapping them by objective, operational friction, and overall risk. Physical bullion is an extreme counterparty risk hedge. It removes your wealth from the digital banking system entirely, but it requires accepting high friction in the form of dealer premiums, secure storage, and insurance. Gold ETFs, like GLDM or AAU, act as the core, low-friction portfolio tool. They offer immediate, highly liquid price exposure for macro allocation without the logistical drag of storing physical bars. Individual miners and equity indices belong strictly in a tactical, cyclical torque sleeve. They provide explosive margin potential during confirmed uptrends, but should never replace core physical holdings as a structural reserve. Deployment requires discipline. An institutional allocator waits for specific macro triggers, namely gold reclaiming its 200-day moving average, combined with a confirmed plateau or drop in the 10-year TIPS real yield. The structural sovereign demand for gold remains entirely intact, but until real yields stop rising, the bond market controls the discount rate, and data-driven allocators do not fight the bond market.